Today, we're going to be talking about whether US yields are about to cap the stock rally. And then we're going to move on to the Magnificent Seven, why it's a problem that 7 stocks make up 30% of the S&P 500's movement. And then the trading takeout today is going to be how much is your trading really costing you? Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So yes, yesterday we had the US CPI number, which came in ever so slightly hot at 3.7% versus the expected 3.6%. And this led to, a rally in US yields, in the US risk-free rate of return, which tends to have a poor effect on equities because of the opportunity cost nature of it. People would then prefer to be able to put their money into a lower risk asset and to get a higher yield basically back. And this is what happened. Here's the CPI number being released. Equities rallied by about 15, 16 basis points. US yields rallied by about 15, 16 basis points. And now we're trading at 4.65%. From looking initially here, I'd argue that we've made quite a strong base. And we'd probably look for yields to rally back up towards the 5% level, which would start to really, really cause some strain in the treasury market. I said it a few weeks ago as well when we were trading up here. Still maintain that we're not done yet in terms of this, the treasury sell-off, and still think that yields, maintain all the way up to 5%. I mean, if you look at this technically even, it's a perfect example of somewhere that could get picked off quite simply. So I think, in terms of equities being capped, if we look at the NQ here, so we look at the NASDAQ E-mini futures, we traded here previously, which was the big sell-off. Now, it looks like we have potential to do the same thing here. It's almost even the same bar pattern occurring, maybe slightly differently, but we took the previous close to the upside and then traded off. Here we did the same. We took the previous open to the upside and then traded down. I personally think that this is a key level. I cannot recall why I've got this marked out, but it's about 15,000. I think that's called a gamma level, but I'm not going to get into that right now. It's basically where dealers are trading the market in a different way via options. But I'm pretty sure that this is a very, very key level. And we've also got a gap just here as well. So there's a big old gap you can see here. We gapped down on Monday. And, it tends to mean that there needs to be some sort of filling. So I don't know if that will happen today, but I think that's probably an adequate target, especially with where yields are going. And more specific to the NASDAQ, because it's very tech heavy, and I'm going to get onto something to do with the tech sector in a sec. But because it's very tech heavy, it's very sensitive to yields rising. So if we do see a sustained rally in yields, then it's likely that we will see this come off pretty rapidly, especially if that yield rally happens today into the back end of the week. We saw some buying of US Treasuries through the start of the week. Now, if we see some squaring off of positions, that could get quite messy into today's close. And I would not be surprised if we were to see 15K today. That seems crazy, but that's the way that it feels positioned to me. So I think that yields rallying up towards the 4.8% level in the 10-year could really cause a bit of a strain. Don't think it will just, get straight up there today or in the next day or two, next trading day or two. But I do think that's the trajectory we're going on, and that is the path down for equities. I think we do start ticking down to here on the NASDAQ. ES probably a little bit different, probably about 43.50, something like that. It doesn't look great again from the perspective of where yields are versus equities. And even if you do some simple technical analysis, you could throw a trend line there. You could also maybe chuck one here, and you can see that there's sort of this channel building up, which you could say, that's a resistance level there. We're trading down here. This is probably a very key level going across. 14,268 on the NASDAQ, possibly something to look at. I don't really look at horizontal levels, but it's good to identify them as places to potentially do business at. Now, leading on from what we just spoke about with regards to yields capping the market, I mentioned and touched on the NASDAQ there. And it's very, very pertinent because the same stocks that really cause the outsized returns in the NASDAQ, so Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, also cause 30% of the movement in the S&P 500. Now, because these stocks are very, very sensitive to the US 10-year yield, it means that as part of the S&P 500 as well, they can drag the index down considerably. Now, if the 10-year yield is rallying heavily, then what does that mean for the S&P 500? Relatively speaking, it's like a seesaw. Yields up, equities down generally. It depends on the velocity of the move, of course. So I always mention about outsized surprise. If we do get a fast move in yields, then it means that there's going to be quick downside in equities. And the fact that 30% of the S&P 500 market cap is made up of these 7 magnificent stocks, if you like, which are large tech stocks, it means that the S&P 500 is actually very, very sensitive to moves in the US 10-year yield. So what we need to look out for over the next couple of days is, okay, we've seen this reversion in yields recently. They traded up at 4.8% on the 10-year, traded down to about 4.5%, just above 4.5% through the start of the week. If we start to see the tick up, which I think we are, and we've already started to see it off the back of this CPI, which was yesterday, then we should see further equities downside. So you might want to start hedging out some of your short positions, some of your long positions, or just closing them out and potentially looking at getting short. It totally depends on what your trading style is. I know some of you are long only, some of you are short only. So, it's key to really focus on where you think the risks are to your own trading style here, because yields up quickly tends to be quite, negative for equities, especially in the space that we're in now, where so much of the S&P 500's market cap is dominated by such a small proportion of stocks. So, yeah, that's what I would look at. I would look at any risks that you think and you might perceive to your equity holdings. See if you can hedge them out a little bit. Today's trading takeout is know your trading costs. And I say this because I asked someone this question at an event a couple of weeks ago, because they was asking me complex questions about macro, and they were asking me, how do you prioritize? And I said to them, well, firstly, let me ask you, do you know what your trading costs for the year are? And they didn't know how to answer. So, my response to them was, well, that is an immediate implicit negative to your trading. If you don't know what your business costs are, then there's no point trying to work out, what the next Fed meeting is gonna look and sound like. You need to understand what your direct costs of business are first. And a lot of people, if you were to ask them this question, probably some of you included, they wouldn't actually know. So the first thing that you can do to minimize your trading costs is only use limit orders. Because when you're using market orders, what's occurring is, you're actually just getting the best fill at the time. You're not getting the fill that you desire at the market price. You can get slipped, you can get requoted in some cases. And if you are getting requoted, then change your broker. But that is the instant change that you can make, is to only use limit orders and not market orders. Do not just hit buy and sell, because you don't know what your costs are really going to be. And it's going to be very difficult for you over time to work out the extent of your edge, because your costs are going to be so variable. Whereas if you're using limit orders, you're able just to get into the market at exactly the price that you desire. There's no change, and you can work out your edge far, far better. So that is the number one tip. The second tip as well is to try and actually, bargain with your broker as to what your commissions might be. Sometimes they let you off, especially if they see an uptick in volume. So they might decrease your round trip costs. So I think those are the number two things to really, really focus on. If you don't know those things, then prioritize getting to know them, because like any business, you need to know your costs.